On the call this morning, U.S. futures are down on European debt concerns as the Spanish Socialist Party suffers its worst election defeat in 30 years amid a backlash over austerity measures. United Continental is lower by 3% in pre-market trading as volcanic ash over Iceland may threaten travel. And commodities extend losses into a third week led by copper and crude oil, both down over 2%. I'm Alex Steele, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer with T3Live.com.
And I'm Alex Steele with The Street, and together we bring you the morning call. Scott, I have to say I'm glad we made it. The end of the world didn't happen on Saturday, so it's good to see you again.
Yes.
But the markets are not having such a good day. They are really struggling. The Dow's down already, triple digits here. So where's the next level of support that you're seeing on the S&P, and how painful is the sell-off today?
Well, you do remember last week we talked about the 50-day moving average probably holding. That was around 1325. That's where we had that oversold bounce from Tuesday into Thursday. I don't think today is too painful for those that watch the show because we said take the easy bounce. Let's figure it out later. The easy bounce was from the 50-day back to we talked about 1340, 1345. We saw that on Thursday. The market actually held in a little bit better because of the excitement of that LinkedIn IPO. And then Friday, we started to trade off a little bit. I think most traders went neutral because there were big arguments for the bearish side, the bullish side. So at that point, most people took a step back. And if you did so, you're coming in today, and we can actually give you some things to look at to make some cash flow and maybe invest.
So is this sell-off today sort of indicative of a larger correction here, or is it, like you said, a good place to start buying because you think it'll go higher?
Well, we're going to watch last Tuesday's low. That's going to be a spot to look at because we came like 3.5% to 4% off the highs before we found footing last week, and people were saying 10, 12%, but you never know until it starts unraveling. So today, I'm going to look at 1320 to 1325. If you look at the chart here, you will see this is where we bounced the last time, okay, into support. My moving average is in the right, it's not there right now, but that's fine. So I would watch this 1318. Okay, we're opening very close to this area. If this area were to hold and you see some stocks go green, on a day like today, when there's a sea of red, you need to see if any groups go green, if anything could lead us out of this big down move. But right now, that 1318 to 1325 is big, but also something I didn't like is the Russell. We talked about the break in the Russell, and if you look at the Russell, all it did was do a retest of that broken uptrend. So if you look right here, you're going to see that this is what happens in a bearish tape. You have an uptrend that gets broken. So if you get out, great. If you get short, okay. If you miss it, some people re-short the retest of that broken line. And now we're going to start heading lower. We'll probably be testing this low area of 815. If this doesn't hold, we're probably going to see a move in the Russell down to 799, which will be bad for the growth area of the market. And sometimes that's a leading indicator for the bigger indices to follow along.
I'm also hearing very strong conviction from the bulls and the bears, which I think is a little confusing. We're not seeing that wishy-washiness that I think we saw a while ago. So I talked to Mark Arbiter, who's the chief technical strategist at S&P on Friday, and he also had a weekend note that basically said that the S&P's breakout to new highs failed and that recent price formation looks similar to the market peak in 2007. And he says because we're hitting, if May closes below or touches 1294 of the S&P, that'll be the first month with a new high and a new low versus the month before since 2007. But then if you're reading the Wall Street Journal today on the C section, it says, hey, you know what? The sell-off hasn't been that big of a deal. It forecasts stronger trends later down the road. Which camp?
Well, you know what, that's why
it's really tricky.
It's a tricky spot, and that's why you have to be flexible and you have to judge it along the way. That's why we sell into excitement. That's why we sell leading groups when they start to break their 10-day and their 21-day, because you could always buy it back at the 100-day or 200-day. I do think that 1294, I keep hearing that level, rightly so, because if you take one last look at these charts here, you will see that this was the area that we held way back before we had that last move. Remember we talked about that inverted head and shoulders pattern? This was that level, okay, right here. So if we break this level of about 1318, this is my next level to watch. But I don't think if we touch it, that all of a sudden that means that we're going to, just meander or cascade down to the 200-day. But if we do, look where that is. That's the low of the Japan crisis, around 1249. So we will measure it along the way, and there will be a lot to look for. So everyone better make sure that they